Good day, traders. This is Rick. This is the with Futures Trading Coach. This is the fourth video we have. I was going to do a couple smaller videos, but I think I'm going to just roll them up and we'll just leave it off at four. We did one on our S play, our RS, and our ZL. We did another one on our power play and understanding trade entries. We did a third one on our normal trade management philosophy that we like to have. This one I'm just going to group the rest of the stuff and cover everything else as best as I can. We're going to talk about some advanced trade management. What I mean by that is options for people who don't want to do the normal trade management, who'd like to maybe trade a little bit tighter and things like that if they feel a little bit better about it. As far as, taking profits and moving our stops quicker and things like that. We'll talk about trades that I sometimes call during the market on open, which is the first three candles of the day. Of the session and news, to try to dive a little bit into trailing stops and some other things. So this will be kind of like like a bonus little video. And we're going to start here with advanced trade management with a trade with three contracts. It's going to be a short, and I'm going to run through a few things as we're in this trade. So we're looking at a short here with three contracts, and we're looking for a print of 21.44 in the market. I'm going to speed this thing along a little bit just to get us into the trade. Okay, so now once we get filled here, okay, I just had a default ATM setup here that I use sometimes, but we're going to go and we're going to put this target 141 point. We'll do target 2 at 2 points, and we'll just do target 43 down here just to show you how things go. Now we start out with an initial 2-point stop, so our stop's going to be up at 46. Okay, and actually we're going to add on this one, but we're not going to have to. But if we had to add, we would put an add on at 45 or at 46, and then we would get out if it came down close to break even, as we talked about in the previous videos. But for this purpose, for this trade, we're just going to have a 2-point stop. So we're going to have the 2-point stop, and normally what would happen is once our first target gets filled, okay, at 1 point, we would go -1 and we would move our stop down to 45. That's what we would normally do. We'd have 2 contracts left, so we would reduce our risk with 3 contracts, but we would still have minor risk. So we're basically having a $300 risk here, and we make $50 on 1 contract. We go -1 with the other 2, and we could lose 100 on the other 2. So we basically are still risking $50. But what we've done, this is normal trade management, we would reduce our contracts or reduce our risk basically in this trade from $300 all the way down to $50. Now, I'm going to give you guys a couple options here. Let's go ahead and let's get filled here. Okay, so we're filled on our first lot, and what we're going to do now, very simply, is we're going to move one. We're going to put 1 stop, okay, at entry. And we're going to put our second contract that we have left, because we have 2 remaining, right, to -1. Therefore, what we've essentially done, okay, and we'll just move this out of the way, you can cancel it or whatever. So what we've essentially done now is we've gotten $50. We would break even on the second one, but we would still have this runner in case this came up and went down and actually ended up working. Okay, so that's actually what happened here. This comes up here, okay, and you only got 1 left now, so you made 50 and you made nothing, okay, and now we go minus here. If we lose 50 on this, then it's a break even, right? But we still leave that runner there. We reduce our risk even further now, because instead of risking 50 on a normal management, we're basically going to do a break even, okay, and if it does keep going down, we're still in the trade. Now the situation is, once it goes 2 points, okay, you can, since you got taken out on this one, you can go and take your 2 points. If you don't want to take your 2 points, you move your stop down. Okay, you move your stop down anyway if you want to, and this tightens things up. Now you have no risk in the trade. Okay, and you can try to get filled the 2 points, or let's say if I had a target down here, let's say I said, all right guys, we're looking for maybe like 41 here, okay, well you can take 2 points, or you can go to entry and you can have your target down here and try to get 41. Okay, but in any event, the purpose of this is to show you that you can go ahead and do that. Now another example, You'll see here that that was just filled, and you played that with a little bit tighter risk management. Now, there isn't a couple caveats to that because you only have one runner, but you're tightening up your potential losses on that. Another option would be getting into the same trade with 3 contracts. Okay, and once we're filled on the trade, okay, we're going to still wait for our point. Okay, 43. We're going to still wait for our point. Okay, we're going to have our 2-point stop. Okay, we're going to wait for our point. And this is more aggressive as far as being tighter. Okay, meaning being more cautious. Okay, and you will make, over the course of 50 or 100 or 200 or 300 trades, you will make less doing it the way I just described before. But the percentage that you'll make less versus the fact that you're getting into a risk-free trade quicker may appeal to, less of an aggressive trader, possibly. And you have to see how that works out for you. Now, the next example would be what I call guaranteed money after the first target. Okay, guaranteed money after the first target says, okay, we got a point, we're just going to entry. That is super tight. Okay, and you'll see here, because it was the same trade as last time, you're going to get taken out of the trade and make $50 less the commissions. That's one way that you can basically do that. 2 different ways you can do that. The first example I gave you was tighter management than our default, and the last trade that I just showed you is even tighter, meaning you will get taken out of these at some point. But if you feel better, like, oh, I'm risking 3 contracts, I'm going to go, so we don't really recommend that one. If you wanted to do the first option, that's okay. But again, you will get taken out of at least the one that you had left, 1 out of the 2 you had left. Sometimes you won't. Okay, and if it makes you feel better to do that, then that would be fine. Now, so when we get filled here on this one, this is going to be with 2 contracts. 2 contracts. We'll go -2, and once we get filled on the first target, which would be at 43, then we'll just go right away to entry with the second one, and now you have none left. So it's either going to come up to entry and take you out, which we know that it will, okay, and that's how you would do it with 2 contracts. Or if it just kept coming down, then you would, either have your second target or whatever, 2 points, or wherever my next target is, which I'll put on the line. You'll see me put circles or lines and things like that, and we're talking about it and things like that in the room. That's how you would manage those. And I call it with 3 contracts. The first example again was risk-free after a point, or risk-free after first target, and then the more tighter one was guaranteed money, although it'll be a little bit on the ones that come back after target 1. Again, we've done the research on it, on the exact trades. We've kind of plotted it all out, and again, you will make less money with the guaranteed money after target 1. You will make a little bit more, but less than our normal trade management with the first option that I gave you when we first started the video out. However, you will reduce your risk quicker. Okay, so that's the way it's kind of played out, and if that's what people feel more comfortable with, that is perfectly fine, because it's not all things to all people. Some traders are a little bit more aggressive, some traders are a little bit more on the conservative side, and especially when you're in the call room until you decide to learn the methodology, you might want to opt for one of these options. Now, I'd like to discuss another topic, and that is market on open and news trades. Market on open trades we define as the first 3 candles of the session, of the S&P session, but they do cover all the markets that we trade. Then we also have our news trades that come around major news events that affect the S&P, as well as the crude oil report. Now, interestingly enough, when a lot of our trades set up, they actually work in the direction that we thought. The news actually just helps them go. The problem with it is that it, as most people know that have been trading, it creates a lot of volatility. And it's the volatility that we really have to respect. It's not necessarily we're afraid that we get long 5 seconds after the news comes out and it's going to go and reverse the other way on us. I mean, that can happen, but I mean, most of the time, our winning percentage is the same at the news as without the news. However, um, during that time, the market can create a lot of volatility, and that can be a little bit troublesome for people. And we get that. So basically what I do, a lot of times we won't call out trades during the news. If I do see something that looks nice during the news, I'll give people the option to take the trade. If it's not for you, if it's something that's not for you, and I'm going to give you an example of what some candles can look like during the news, especially the crude report. If that's not for you, make sure you're on the simulator, or just to be sure, don't take the trade. Double check, triple check, all that kind of stuff. So for example, this was a trade that happened last Wednesday. So here's an example of this trade that I had called, like I said. Basically what I said was that if the market got to 51.55, that we would take it up for those who wanted to take the trade. Now, what that means is if you want to take this trade, you would have a buy stop there, and the market the news is gonna come out here momentarily on this trade, and we see what happens. Now I want you to see, okay, and this is going to be in real time. I'm not going to speed it up because I want you to see what's actually going to happen when this news comes out, okay? So let's watch and see. So look at what happened there. Okay, now that's pretty fast for some people. Okay, now you could have been in the trade, obviously, and this is actually slow. This is actually kind of a tame example. I was just trying to find the quickest one. This went up here. Okay, but this actually, you would have been in here at 55, and obviously we would have had 20 pennies already. This is like slow, for a report. Basically, this could have came up, it could have ticked to 55, it could have came down really quick, it could have been, really quick motions like so. So it's not for everybody. It's just not for everybody, that type of action. But if it is, when I see something that sets up, occasionally I will call trades during the news. And, for those people who want to take them, they can take them. We also get questions sometimes about trailing stops. So let's say, for example, you were in this trade. Okay, let's say we're long here at 55, and the market starts going up. What I hear a lot of people say is, about right now, get your 20 ticks. And then I hear some people say, well, I'm going to move my stop up, to entry, or I'm going to move my stop up to 70 and trail it or whatever. You can't do that yet, because what ends up happening is there's movements in the market, and based on what levels we have here, okay, like we've got a level right here, okay, so we expect the market's going to come down a little bit, okay, as there was actually a little one at 75 or so as well. So what ends up happening is you move your stop up too quick, right? The market comes down, and again, this is, big knee-jerk reactions because of the news. Look at these, these candles, okay, the way they're moving. You get taken out, right? Because, you're right around here. You get taken out as your entry, and then, the market continues to come up. So what you need to do is listen to the cues, okay, for people who have the contracts and trail and want to trail. There is a time and a place for trailing. When the market travels a certain distance and gets over certain key hurdles and things like that, or key levels, like we like to call them, I will give you the navigation the best I can for people. If you took 20 pennies here on this particular trade and you were out of the trade, great. You're out of the trade, you wait for the next trade. If you run out of contracts or whatever the case may be, there's nothing wrong with that. On a news trade or on a regular trade. You watch these videos, you're going to find that the trades are going to be easy to follow. Some are a little bit quicker, some are a little bit slower. So I hope the video helped you. This is the 4th video we're doing in the series. If anybody has an idea for anything else they'd like to see, I'd be happy to do a 5th or a 6th one or whatever on other things. We'll go from there. So until then, guys, I hope these helped. See you in the trading room.